Hi, welcome to Academic Market Insights. I'm Dr. Russell Rhoads, flying a little solo today, but wanted to jump on a trade that's got me scratching my head a bit. And I just came off a volatility podcast where the other folks participating in the podcast were also like, why on this trade? So going to run through the trade, run through what I'm thinking behind it. If anyone has some insight or some thoughts, something I might be missing on this one, please shoot me an email, and our email address is at the very end. So let's get going. Now, as mentioned, I came across a VIX 20 200 bear put spread that expires in December. Typically, most VIX option trading occurs in the front couple of months. So that's unusual. It's very rare. I don't think I've ever actually commented on an option trade in the VIX arena that had a 200 strike price. So a couple of reasons this thing caught my eye. Now, I came across the July 14th trade, and that led me into doing a little forensic tape reading, and I noted that a very similar trade occurred on July 8th. When you sum up the size here, you get 250 contracts. So I think I'm going to assume that the same entity is behind this trade. So on July 8th, when they started putting this position on, they bought 82 of the VIX December 200 puts for 175.54, and they sold 82 of the VIX December 20 puts for 270. Net cost on that's 172.84. And then on July 14th, the first trade that I came across, they bought 168 of those 200 puts. They paid 175.54 for them again. They did sell the VIX 20 puts at a slightly lower price at 262. Net cost on that leg was 172.92. When I do a little math and average them together, we come up with a net cost of around 172.90. And a full position, again, of long 100 and 200, long 250 of the DEES 200 puts, short 250 of the DEES 20 puts. So what do they get with this position? Well, they get the stereotypical looking bear put spread payoff. And the best case scenario in this trade is, there we go, maximum, going ahead, getting ahead a little bit, maximum gain of $7.10 as long as VIX settlement in December is below 20, and they hold this trade to settlement in December. The break even is 27.10, and we're going to take a look at this 27.10 in just a second relative to history and see if this trade makes some sense. And then finally, and I'm going to say this is a theoretical loss, the maximum theoretical loss is 172.90, or what was paid for this trade. That would involve VIX settlement at 200. The highest VIX settlement that I believe we have had on record is, if I remember correctly, I believe in the 60s. And in fact, I'm pulling up a list of them right now. I just happen to have a spreadsheet open. In November of 2008, the November 2008 VIX futures and options settled at 67.22. So it is possible that we could have a VIX settlement up in this area that would result in a big loss on this trade. So putting up 172.90 for basically August, September, October, November, and December for 5 months, to, if everything goes right, make $7.10. So I did a little digging, and I took, and this historical with an asterisk, this just means if we had done these trades at the same prices in July of each of these years and held it through settlement, what would the profit or loss be on this trade? And there's only one red number on here, and that's that 2008 time period, where I mentioned the November settlement was 67, December settlement was 51.29, and the result there is basically a loss of 24.19 points. So let's just say $24.19. You can see there are a lot of 710s on here. I think 10 of the 19 VIX settled below 20. The VIX settlement ticker is VRO, for those that are not familiar. And anytime that happened, the net result was that full $7.10. Several partial gains in here as well, and only one loss. So maybe they took a look at what the VIX settlement has been over the past 10, 15 years or so. Maybe they didn't see that December 2008 one, but it looks to me like they're playing this based on some sort of odds with respect to historical December settlement. Again, note only one of them has been above that 27.10 break even spot. So my thoughts, based on the historical VIX settlement prices, the trade kind of makes sense. I think there are probably better ways to have done this. Maybe use the 100 strike put instead of the 200 strike put. Been able to put up less capital. Maybe the break even goes down a bit. I am again scratching my head over this one. Still trying to figure out exactly what we think may have been going on here. The dollar risk reward plus the amount of capital that tied up gives me a pause, to say the least. The net result is just under $4.3 million cost for this trade, shooting for a profit of, I think, around $200,000 if I've got that correct. That's also I think less than a 4% return over 3 months. Going to continue to watch this trade for any changes. Did they exit? Are they adding to it? Maybe if they have an opportunity to, and report back. May not be reporting back until December settlement, depending on what they are doing around this. And we've had some requests on how to get hold of us. The best way to get hold of us, both Dr. Ademiak and I have access to academicmarketinsights@gmail.com. It's just a common email address that we use and that we share for this channel. So with that, I appreciate you giving me a few minutes. I hope some people have some good thoughts on this trade. If you liked this video, hit the thumbs up and let me know. I can do more short-term trade videos. It's an area that I love digging into. If you're new to this channel, you'll see I just did one on Lilly based on a student's question. And anybody comes across a block trade and asks a question about it, feel free to shoot me an email and we will slap a video up on that. So with that, it's Friday as I record this. I hope everybody has a good weekend, and we will see you guys on the next episode.